Subsidiary acquisition with Goodwill. When acquiring a subsidiary for a sale price above fair value that results in goodwill, these are the steps that are taken. So you adjust the subsidiary's balance sheet account. So always first step, revalue everything, put everything to fair value, and essentially you just use the fair value. Like if fair value is given, you just use that. Allocate remaining acquisition cost to fair value of any identifiable intangible assets that were acquired. Then allocate remaining acquisition cost to goodwill. All this is saying is account for goodwill as your purchase price compared to fair value. Now, here are some normal intangibles that can be amortized, right? We're talking about goodwill, we're talking about intangibles. So, goodwill created from acquisitions is treated differently from goodwill in other situations. Usually it will be amortized. However, when it's created by an acquisition, it is subject to impairment testing. So, it's kind of like saying we've got depreciation, right? We've got fixed assets and those are depreciated. This is kind of like land. Actually, I think this is a great example. Compared to land, you don't depreciate land. Normal intangibles you amortize, just like normal fixed assets you depreciate. But with land, you don't depreciate it, but you can write it down. You can impair land because let's say, you got some, land and all of a sudden maybe there's chemicals on it or it's not as valuable as it once was. You can impair it, write it down. So that's the same thing that's going on here. That's actually the same exact thing. And impairment, this is like a one-time write down, just like you would for land, whereas this is the process, right? Straight line amortization, straight line depreciation. So there's a test to determine if it should be impaired. We kind of went through impairing that before, right? You're going to do your qualitative and quantitative test. During the period that the goodwill is determined to be impaired, it's written down and charged as an expense against an income on the income statement. Great example here, something great to see. But yeah, you'll see this in the intangible section if you haven't already. These are just all normal intangible assets that are going to be amortized over a certain period of time.